There are a lot of tools out there for ESG investing. Today's video is an introduction to MSCI's ESG ratings. A little background about MSCI before we get started. MSCI is a company that arranges stocks into indexes. MSCI was founded in 1968 as Capital International, a company that published indexes on non-US global stock market. In 1986, Morgan Stanley licensed the right to their indexes, and the company was rebranded as Morgan Stanley Capital International Indexes, or MSCI. Since 2009, the company has been independent of Morgan Stanley. MSCI's biggest customer is BlackRock, the world's largest asset manager. MSCI led the foray into ESG investing in 2019 when the CEO announced that MSCI's data products were just a means to an end. The actual mission of MSCI is to help global investors build better portfolios for a better world. Bloomberg Intelligence estimates that 60% of all the money retail investors have put into ESG funds have been built on MSCI ratings. MSCI earns about 40 cents out of every dollar the investment industry spends on ESG data. However, MSCI has been in the news a lot recently for criticisms that there's virtually no connection between its stated marketing campaign of making the world a better place and the methodology it uses to create ESG ratings. This is the most compelling article that I found on this criticism. It was published by Bloomberg in December of last year, and I'll link it down below. With that context, let's take a look at MSCI's ESG ratings. You can find the ratings by navigating to MSCI's homepage, going to Our Solutions, ESG investing, and clicking on ESG ratings. The first thing that's going to pop up is this nice video. It essentially says that ESG ratings can help investors pick up risk not identified by traditional financials, and it talks about its methodology and rating system. MSCI's ESG ratings are lettered, just like companies' credit ratings. AAA is the best and CCC is the worst. Using this lettered system rather than numbers like a 1 to 10 scale or risk percentage has come under fire for creating the aura of legitimacy when, in fact, ESG scores are unregulated and don't have the consistency across rating agencies that credit ratings do. Personally, I think it's smart of them to mimic a well-known standard, but I can see where it can lead to problems if investors don't do their background research. Let's look at an ESG rating. We'll use Tesla as an example because they're one of my favorite companies and well known. There are two parts to the rating, a climate score and an ESG score. Let's quickly talk about the climate score before getting back to the ESG score. Tesla gets an implied temperature rise score of 2.6 degrees Celsius, which is misaligned with global targets for climate change. How does MSCI calculate this? Here's their implied temperature rise overview. To get the implied temperature rise score, MSCI looks at the remaining budget left for the world if we are to keep warming this century well below 2 degrees Celsius. They use this budget and allocate an amount to about 10,000 public companies. This step makes sense since only about 100 companies are responsible for 71% of the global carbon emissions. Having 10,000 public companies included in this methodology should account for the vast, if not the total amount of carbon in the atmosphere. Then MSCI looks at all the public companies' projected emissions over the next 5 decades based on their current emissions and MSCI's analysis of the company's stated reduction targets. All things being equal, a company whose projected emissions are below budget can be said to undershoot, while those whose projected emissions exceed the budget overshoot. The over or undershoot is then converted to implied global temperature rise, meaning how much would the temperature of the world increase if the whole economy had the same carbon overshoot or undershoot as the company in question. At the bottom of the page, they have some key features of their methodology. Two things to point out here. One is that this analysis covers companies' Scope 1, 2, and 3 carbon emissions. It's critical that Scope 3 emissions are covered in any analysis. Scope 3 emissions are all the indirect emissions that are not included in a company's Scope 2 emissions that occur in the value chain for both companies' upstream and downstream activities. The other thing to note is that this analysis is aligned with the TCFD, or the Task Force on Climate-Related Financial Disclosures, which is the leading framework to help companies disclose climate-related financial risks. Still, even though the methodology looks good, it seems wrong that Tesla should get a misaligned score. Technology that's needed to transition to renewable energy-based economy should get some kind of pass. This is an example of one of the broader criticisms of ESG, that the analysis focuses on the company and not on its product. Tesla also gets demerits for not having a decarbonization target. Moving on to the ESG score. Tesla gets an A. That's the third highest of 7 grades and makes it average among 42 companies in the automobile industry. MSCI rates companies relative to their industry peers. A problem with this approach is that it assumes the average in each peer group is worthy of a BBB rating, which I don't think is the case. Some industries have notoriously bad social and environmental track records. Take, for example, big tobacco, which has a history of lying to the public. MSCI ESG Ratings categorize big tobacco under the industry subgroup consumer staples, but if big tobacco were its own category, this would mean that most of them get B ratings and some would get AAA. And in fact, MSCI gives tobacco company Imperial Brands an A rating. CityWire wrote an article about this and I'll link it down below. Here we can see the ESG rating distribution of the auto industry. 34% are laggards, 55% are average. Tesla falls in line with 26% of auto manufacturers looked at that get an A rating, and 12%, or roughly 5 of the automobile makers looked at, are leaders. The next section shows a graph of Tesla's historic ESG rating. We can see that Tesla's score hasn't changed since April of 2019, but this section can be important. Some studies have suggested that the most important determinant in a company's financial performance is whether its ESG rating has an upward trajectory. The last section of the ESG rating is a summary of the subcomponents of Tesla's ESG score that contribute to its overall rating. When MSCI gives ratings by industry, what that means is all of the factors that could affect a company's score, only the top material risks for that industry are considered. Here is the key issue framework that shows all 35 key issues MSCI considers across 10 themes. MSCI has a tool, the Industry Materiality Map, to show you what key issues its committee selects for each industry. So let's just navigate to consumer discretionary, and we'll find automobile manufacturers. The key issues that MSCI finds relevant to the automobile manufacturers for the environment are product carbon footprint, opportunities in clean technology, and toxic emissions and waste. For social, the key issues are product safety and quality, labor management, and chemical safety. For governance, the key issues are ownership and control, board, pay, accounting, business ethics, and tax transparency. Note, MSCI considers all the key issues under governance. MSCI considers this the most important section, and governance always makes up a minimum of 33% of a company's ESG score. This little CS here means company specific and is not relevant to all the companies within the sub-industry. Also note that the average weight is given for each key issue. Because of the company's specific issues, not every company is going to be assessed with the same weights for each issue. This is one place that I really wish MSCI would be more transparent. I can't find anywhere that breaks down companies' scores at the key issue level, laying out which weights are applied to which companies. Now back to the last illustration of Tesla's ESG rating, the table of how it performs on key issues compared to peers. For product quality and safety, which is a social issue, Tesla is considered a laggard. Last year, Tesla recalled about 500,000 cars for safety issues, so okay. Next, for corporate governance, which includes all 6 of the governance key issues and makes up about 33% of Tesla's overall score, Tesla scored an average. It also was average for labor management. Where Tesla leads the automobile industry is corporate behavior, product carbon footprint, and opportunities in clean tech. And that's all for an introduction to MSCI's ESG rating tool. The methodologies for both the ESG scored and the implied temperature rise can be found online. A reminder about some of the pitfalls of this tool. The first is that the scores are normalized by industry. This makes them comparable only to other companies in the same industry. It also assumes that the average company in a given industry is deserving of a BBB score. The next thing is that MSCI's ESG ratings sometimes vary greatly from other score providers. There's no regulation and little standardization of ESG scores yet. And the last point to remember is that the scores are a measure of risk for the company. They do not reflect the company's impact on the natural world. If you want to learn more about MSCI's ESG ratings, you can check out MSCI's page, What MSCI's ESG Ratings Are and Are Not. Also, this ESG industry materiality map is kind of fun to explore, and definitely read Bloomberg's The ESG Mirage article and CityWire's How Tobacco Stocks Can Perversely Score Highly on ESG. The Bloomberg and CityWire articles are linked below.